So we have chosen to analyze Netflix as our company of focus. They have a ticker that is NFLX. We will examine its Form 10-K along with their related financial statements, their business model, management discussion and analysis, and other disclosures just with the end goal of representing why Netflix is a strong investment opportunity for shareholders. So starting with just a basic company overview, Netflix is in the communication services sector as part of the entertainment industry. Their key activities include production and licensing as well as technology development. As of September 21st, Netflix's stock was valued at $1,229.97. This is about a 3% increase from their week prior stock price on September 15th. Netflix is modeled by their value proposition, which is watch on demand entertainment when and where you want it. Their key revenue streams are subscriptions. Their standard subscription is $17.99 a month, but they also have an ad-supported plan, which I will describe in greater detail shortly. Some other relevant descriptors, just from basic company overview, is their earnings per share ratio of 26.3. The earnings per share ratio indicates how much profit each outstanding share of common stock has earned. This is a very strong earnings per share. It indicates high profitability and just potential for reinvestment. Based on their earnings per share trends, Netflix projects about a 32.39 earnings per share in 2026. Their price to earnings ratio is 51.29. This ratio just represents the proportion of the company's share price to its earnings price per share. This is a high price to earnings ratio. It reflects that investors are very confident in Netflix's future growth. So some recent highlights and market trends can just help elaborate on the importance of Netflix's market presence. In Q2 of 2024, 30% of their subscriber base were on the ad-supported plan. As stated before, the significance of Netflix's ad-supported plan is very hard to overstate. Ads represent a high margin revenue stream. This gives Netflix more room to expand their profitability without relying solely on the standard subscription package. Netflix has maintained steady subscriber growth with recent expansion into international markets, which contributes significantly to revenue. Their international revenue grew 23% in Q2 of 2024, whereas the US region only grew 15%. And 15% is not a bad growth by any means, but certain hits like Squid Game from South Korea have just proven that global audiences will engage in and embrace Netflix's content when it's compelling. This is an important statistic for Netflix as it really just allows them to open up their platform to more universal groups and users, knowing now that they are interested and that it will be a cost-effective decision for Netflix to spend money on a budget on an international hit. Certain shows like Stranger Things and Bridgerton have also become frameworks for Netflix. They have really shifted from building franchises rather than just producing hits. These have drawn spin-offs, merchandise, long-term engagement, and overall just builds a more stable reputation for Netflix as a entertainment company rather than just producing one thing over and over. And by focusing on these fewer but bigger bets, Netflix improves their cost efficiency and creates opportunities to diversify into areas such as gaming and live events to broaden its entertainment ecosystem and just reduce reliance solely on this standard subscriptions and traditional streaming. So getting into Netflix's Form 10-K, we'll start with a statement of comprehensive analysis. Netflix reports a strong net income growth from $4.49 billion in 2022 to $5.41 billion in 2023, and ultimately $8.71 billion in 2024. This growth just suggests significant improvement in profitability in general, which is likely due to increased subscriptions, price adjustments, and just improved cost control. This higher profitability leads to potential for higher returns. This is something that's very important to investors when deciding what company to invest in. Netflix's total comprehensive income mirrors their net income growth, which has just improved sharply from previous years. This is a result of a large positive contribution in 2024 from cash flow hedge gains. A hedge is basically just a backup investment that helps protect you if your main investment goes under. And Netflix saw about a gain of about 824 million in 2024, which just improved their other comprehensive income category, which you can see was very negative in 2022 and still negative in 2023, but very positive in 2024 from those hedge gains. Regarding their profitability and operating efficiency, Netflix appears to be controlling their content spending relative to their revenue growth. The improved other comprehensive income elements from the hedge gains really just help smooth their earnings volatility and support their stable results. In general, Netflix's statement of comprehensive income highlights that Netflix is just a very scalable company. Scalability leads to future growth potential, and Netflix's ability to grow their subscriber base without also increasing their costs just creates opportunities for larger profits and compounding earnings. And so now I will start reading the slides for our team member who is no longer in the course. So next we'll review Netflix's balance sheet. This allows us to have a better understanding of the elements that contribute to Netflix's strong net income and growth. So for example, current assets make up about 64% of Netflix's total assets. This just indicates a strong short-term resource availability and liquidity. Netflix's non-current assets primarily include investments in plant, property, and equipment, as well as intangibles. These investments signal long-term growth capacity and shows that Netflix is working on building their operational base, giving it a sustained competitive advantage. Netflix has a debt-to-equity ratio of 1.17, which is just their liabilities over their equity. This indicates moderate leverage, with equity financing being the dominant source for them. Netflix also has no preferred stock issued, so common shareholders don't compete with preferred dividends or restricted cash. All earnings growth just flows directly to the common equity holders. Netflix also has a current ratio of 1.22, which is just their current assets over their current liabilities. This indicates that they have a strong liquidity position and ability to pay off their current obligations as they come due. They also have about $2.34 million in working capital, which is just the difference between their current assets and current liabilities. This shows that they just have an ample buffer for their short-term obligations and that paying them off as they come won't put Netflix into a debt position. In general, Netflix has strong solvency, where their equity exceeds their liabilities, which is a sign of long-term financial health and resilience. Next, we'll look at Netflix's statement of cash flows. So this chart on the right is really just a bar chart of what a table would have been, with operating in orange, investing in blue, and financing in green. So operating cash flow has been positive. It was $2 billion in 2022 and $2.2 billion in the first quarter of 2024. This tells us that subscriptions are bringing in steady cash and that Netflix is introducing cost-efficient elements into their business model. To look at investing cash flow, it's consistently negative, like it was negative $2 billion in 2022, but this is just because Netflix is constantly pouring money into new content. Basically, every Netflix original shows up as an investment. So these show up as investing outflows for budgeting purposes, but it's mirrored as in operating inflow for about the same amount. And then we have financing cash flows, which were negative $600 million in 2022. This is mainly because they're just repaying their debt and buying back treasury stock. So these numbers may seem unconvincing and detrimental, but the transparency that Netflix is presenting allows investors to feel secure in their decision and that they are truly aware of what Netflix is generating and are not in the dark about anything. And the key thing to notice here is that there is often a gap between net income and free cash flow. This is because Netflix spends the cash on content upfront, but GAAP lets them spread the expense over the years. So free cash flow looks tighter than net income. Moving on to the statement of stockholders' equity. This is basically just what belongs to shareholders. From 2023 to 2024, Netflix's equity rose from about 20.6 billion to 24.7 billion. This is a healthy increase. It's nothing super crazy or out of the ordinary, and it's not necessarily due to anything specific, but it is good that Netflix's equity seems to be growing at that steady rate. However, saying that most of that equity did come from retained earnings, which is just profits that Netflix kept, which grew from 22.6 to 31.3 billion. What's interesting to look at is the accumulated other comprehensive income. This flipped from negative 200 million to positive 360 million, and this is mostly due to the hedge gains that we touched on when talking about the statement of comprehensive income analysis. And at the same time, stock buybacks are pulling equity down. So there is a balancing act here where profitability is boosting equity, but buybacks are reducing it simultaneously. But the overall takeaway is that equity is growing, but it reflects both profit growth and shareholder return strategies. So finally, we'll talk about the GAAP application, not just for cash and equity, but across Netflix's whole financial statements. On the income statement, subscription revenue is recognized evenly over the service period, so revenue is steady and predictable. Content costs are capitalized first, then amortized over about 4 years, with most of the expense up front since that's when the viewing happens. On the balance sheet, content assets are one of their biggest items. You also see deferred revenue because subscribers will pay in advance before they watch for the year, and treasury stock shows the impact of buybacks. In the cash flow statement, GAAP requires content spending to show up under operating cash flow, not investing. This makes Netflix's operating cash flow look very different from net income, but it's just simply from a structural change in GAAP application. And then in their disclosures, GAAP requires them to explain their judgments, like how they estimate viewing patterns, how they treat leases under the accounting standards codification 842, and how they account for taxes. So GAAP touches everything from how revenue is recognized to how content flows through the statements and how risks like currency changes are disclosed. But the big picture here is that Netflix is GAAP compliant, but the timing rules, especially around their content, create that gap between their reported income and their real cash.
Okay, so the management, data, and analysis insights. We have a strong financial health of 7.8 billion in cash. We also have seen that we have an operation margin that has increased 6 percentage points from the prior year. We also had noticed that there's 1.78 billion in short-term investments, along with a 32.45 billion competitive advantage involving subscriber growth. We're not facing any risk. Our net income covers our interest expenses. Netflix debt has increased, but that's mainly because of the global expansion and just looking for new content. So it's really manageable. It's nothing to worry about. Our stockholders' equity shows that Netflix can invest in its company or in our company for a long and good health of the future. Not only that, but we also buy back our stocks, which shows our confidence with what we can do for the people. Our liabilities and equity basically are equal, so it just shows a balance in capital structure. Based off the balance sheet, Netflix is more financially stable to look for expansions and newer projects in the future. Because we are still accelerating in 2024, it means we have a strong demand for streaming services and content offerings. Not only that, but our numbers prove that Netflix is in a competitive position in the streaming market, but it also shows that we have enough resources to execute and have the ability to continue to lead in content and creativity. This overall just validates the company's growth, efficiency, subscriber success, and our financial stability. As you can see, this is our chart and it shows the UCAN region. That is the United States and Canada region. This is our most profitable region. This shows our strong revenue growth through higher pricing and more memberships. Not only that, but the net memberships have improved compared to 2023. So our competitors, Disney and Roku. First, Roku, they use AI. They use AI for recommendations through the streaming services that they provide. It helps with their streaming hours, and their ads support their growth as well. Roku also invests in their business as well, which is why they're continuing to grow as well. Risk, we have noticed that the quarterly results show that it may influence a stock decrease. The margin from streaming platforms are slimmer than streaming services, so they need to really stick out compared to their partners or competitors in their market. They also face strong competitors like Apple and Google and more. Roku doesn't own their streaming services, so they're limited to what the streaming services actually show. And depending on their partnership is what dictates what say they have on that content. For Disney, they do own their content. They're not only known for just streaming, they own big franchises like they own Marvel, Pixar, Star Wars, and more. Not only that, but they have amusement parks, merchandise, and advertisements, which can either pay off. Their business is making a very large, revenue and whatnot, which can pay off their liabilities and or investments. Because Disney has multiple routes of making money, they can make they can it can help another route if one is doing not too good than it should, as it should be. Not only that, but streaming isn't Disney's main priority, and because of that, they lack the care or want to improve for their customers, and it's just really not the same as Netflix. Disney's liquidity is tight because of all of those business obligations. Though the businesses are definitely attracting customers, it's still been a strain on the company. We noticed that they have had a decrease in cash equivalents from 14.2 billion to 6 billion. And in 2024, they have they had invested in impairment costs and whatnot, and it just showed that the company struggled through those investments. They struggled to go through and with those. So why Netflix? We can pay off our debt easily while still having a good amount left over for new projects. Our liquidity is strong. Our content asset is important since it demonstrates our continuous investments into original and licensed content. It's been our main factor in keeping and attracting subscribers. Not only that, but it just gives us a competitive advantage. Not only that, but our global expansion, our subscribers are from all over the world, diverse backgrounds and all. There's still areas in where Netflix really isn't like known, and that's something we're trying to work on as we speak. There's various ways to receive income if some of our regions that we do have slow down, which is through our ads, our live events that we are now just doing and more. We use language models as well, and which is AI, and it gives our users a personalized content for each person's like interest, and it suggests things that they may or may not like, but it just gives them that personal, like, we see you like this, yeah, you might like this. We have an ownership, and we can produce originals of the content that we promote, which makes us different from other streaming services. And because of that, we are in a good shape, and we don't plan on stopping now. And we're honestly just getting started and since the streaming industry continues to get harder and competitive, we're continuously looking for new projects to add on and become better. So, one thing to note, that is not nothing you need to worry about when investing in us. We have a hunger to grow. We are constantly looking at ways that we can improve our services, which is why we invest in ourselves. We stay alert of the trends like using AI, personalizing each customer's experience with us, while we always try to make the most reasonable prices for our memberships. We continue to look for ways to improve our streaming services so our customers can be satisfied. And cable is becoming old news, and what we can provide as an original streaming service is the best service for our customers because we care about all of them and their experiences with us, aka value proposition. Watch on demand entertainment where and when you want it.